Of course, this is a fundamental question in economics and personal finance. Here's a detailed breakdown of what happens when the Federal Reserve, the Fed, cuts interest rates, from the big-picture economic goals down to the impact on individuals. First, a quick primer. What is the Fed cutting? The rate you hear about in the news is typically the federal funds rate. This is the interest rate that banks charge each other for overnight loans to meet reserve requirements. It's the benchmark for all other borrowing costs in the economy. The Fed doesn't set this rate by decree. It influences it by buying and selling government bonds. A rate cut makes it cheaper for banks to borrow money from each other. The Fed cuts this rate primarily for one reason: to stimulate the economy. They do this when they see signs of weakness, like rising unemployment, slowing growth, or dangerously low inflation. What happens in the economy? The big picture. 1. Cheaper borrowing. The immediate goal is to make borrowing cheaper for everyone: consumers, businesses, and even the government. Lower interest rates on loans and credit cards encourage people to spend and invest rather than save. 2. Increased spending and investment. Consumers are more likely to finance big-ticket items like cars and homes because loans are cheaper. They may also spend more using credit cards. Businesses are more likely to take out loans to expand operations, build new factories, hire more employees, or invest in new equipment. This boosts economic activity. 3. Boost to the stock market. Lower rates make savings accounts and bonds less attractive, as they pay lower returns. This pushes investors to seek higher returns in the stock market, often driving stock prices up. Additionally, cheaper borrowing can lead to higher corporate profits, which also boosts stock values. 4. Weaker dollar. Lower interest rates make U.S. assets less attractive to foreign investors seeking high returns. This decreased demand for dollars can cause its value to fall relative to other currencies. A weaker dollar makes U.S. exports cheaper for foreign buyers, which helps American companies sell more abroad. 5. Higher inflation, the delicate balance. This is both a goal and a risk. The Fed usually wants a little inflation, around 2%. By stimulating demand, a rate cut can push prices higher. However, if the economy overheats, it can lead to inflation rising too quickly. What it means for you personally, area of your life. Likely effect of a rate cut. Why? Savings accounts and CDs lower returns. Banks immediately lower the interest rates they pay you on deposits. Your savings will grow more slowly. Bonds, existing bond values rise. If you own existing bonds that pay a higher fixed rate, they become more valuable compared to new bonds issued at the new, lower rate. Mortgages, lower rates, usually. Mortgage rates often, but not always, follow the Fed's direction. This can make it cheaper to buy a home or refinance an existing mortgage. Car loans and credit cards, lower borrowing costs. Rates on these variable rate debts often decrease, reducing your interest payments. Stock market, potential for gains. As mentioned, lower rates tend to be a tailwind for the stock market, which is good for your 401k and investment portfolios. Job market, potentially stronger. If businesses expand due to cheaper credit, they may hire more people, making it easier to find a job or get a raise. The potential downsides and risks: rate cuts aren't a magic bullet and come with significant risks. Overheating the economy. If stimulus is applied for too long, it can lead to runaway inflation, where prices rise much faster than wages. Asset bubbles. Cheap money can inflate prices of assets, like housing or stocks, to unsustainable levels, creating a bubble that may eventually pop. Less ammo for a recession. Interest rates can only be cut to zero, or slightly below. If rates are already very low when a recession hits, the Fed has less power to stimulate the economy. This is often called running out of ammunition. Punishes savers. Retirees and others who rely on interest income from safe investments like savings accounts see their earnings drop. Summary: the chain reaction. In essence, a Fed rate cut starts a chain reaction. Fed cuts rate, banks borrow cheaper, banks lower their rates for consumers and businesses, people and companies borrow and spend more, economic activity increases, jobs are created, wages may rise, inflation gradually increases. The Fed's job is to carefully manage this process, trying to boost the economy just enough without letting inflation get out of control. It's a powerful but delicate tool,